let's get across Crown Resorts. It has been deemed unsuitable to hold that gambling license here in Sydney. It is very big news for the company. It went into a trading halt early today, trading halt in place for 2 days, and it comes as a big blow to the company. So it appears as if it will not be holding that Barangaroo license. There is a very big building that has just been finished down the street from us. So it's a $2.2 billion project. Let's get a view from Martin Crabb. He is CIO at Shaw Partners, joining us here live in studio. Because Martin, welcome. I know we've talked in the past about the fact that that real estate is extremely valuable to Crown as an organization, but if you're a gambling house that can't have gamblers in it, that's a big problem.
It is a big problem. So, as you said, $2.2 billion without a casino in it, it's not worth anything like that. Because obviously a big attraction is for high rollers to come from overseas, to have a world-class resort, to spend a bit of money at the tables and have a bit of fun, eat at world-class restaurants, etc. So if you take one piece of that recipe out, then the whole thing sort of falls flat on its face. So where to now? I mean, obviously Crown's going to try and appeal this. You'd have to say the board's gone, the management's gone. They have to have a big clean out, because it wasn't just one rogue operator. It was like systemic issues all through the company, including some issues with James Packer. So it's a difficult circumstance for the company. Obviously now the rumour mill will be on Star Casino. Can they? They've got the all clear to run a casino just across the water there. Can they get together? Can they buy the resort, etc., etc.? So there's going to be a whole lot of issue around that. But it's obviously a very difficult time for Crown and their shareholders, because this will be in the doghouse from an investment perspective for a while. Yeah.
So it looks as if the long-running report has not yet been tabled. That we will have that tabled after question time in Sydney. But it has definitely come to the fore that the New South Wales Independent Liquor and Gaming Authority has said that the casino license should be revoked. Okay, so there's lots to follow through on that story. Star Entertainment just was trying to get its shares up. Can't do that at this very moment. So where to from here in terms of what we have had so far in reporting season? I don't think that you can look past Macquarie today. True, it's an operational update, not technically a report, but shares are up by pretty close to 7%.
Yeah, it's a big move today. So I think it's the strongest performer amongst the leaders. I think James Hardie was up 7% early on, but people got less enthused about that as they went along. But with Macquarie, it wasn't necessarily such a great headline, i.e. our profit's going to be slightly lower than last year. But at their second quarter result, their profits have been really smacked pretty hard, particularly on the trading side of the business, and they've recovered very sharply in the third quarter. So their annuity businesses, which are the banking financial services group and the asset management business, they're flying. They're earning above average return on equity, about 26% return on equity. So they're very, very strong. The markets facing business, which is commodities trading and things like that, they've been struggling, but they're back to about 10% return on equity. But their long-term average is more like 16. So they're still under earning. But one of the issues with Macquarie is how well funded it is. It's got something like $9.5 billion of surplus capital. So that's a big chunk. It's probably about a third of their capital is not required. So they've got to spend that, and they've got to find assets to buy, or they give it back to shareholders. Now, investment banks are not usually known for giving money back to people. They like to hang on to it and earn a fee on it. So Shamara's challenge and Macquarie's challenge is really, how do they deploy that money? We've seen Mira, which is their infrastructure real assets business, bid for Vocus, and obviously they've been bidding for quite a few assets, but $9 or $10 billion is a lot of money to deploy at a tier one capital level. So the challenge is for Macquarie to be able to earn a decent return on that. If they can do it, you can see the profit substantially higher than what it is. So I think part of today's move was reflecting, hey, there's a lot of dry powder in this business, and these guys are going to be doing deals and earning good money on that spare capital. So let's bid the stock higher.
In the banking space, net interest margins are the lifeblood, and you spotted something in the Suncorp results that caught your eye that seems pretty bullish in an era where we're seeing NIMs continually under pressure.
Yeah, so the narrative from last year was, okay, it's a pandemic, so everyone's going to go broke and default on their loan, and also the Reserve Bank's cut rates to zero, so the banks can't charge any, they don't get any benefit from having zero cost deposits. Mortgage rates are going to come down, so bank margins are going to get crunched at a time when the bad and doubtful debts are going through the roof. So everyone just dumped all their banks. Now, as we unwind that narrative, people are starting to get a bit more bullish. So Suncorp have quite a small banking operation. It's quite niche. They're always rumoured to be selling it or merging it with Bank of Queensland. So it's not really the core. When you're buying Suncorp, you're buying a general insurance business. That's what you're buying. But within the bank, we can see their net interest margins actually grew quite substantially. In fact, they're up from 1.92 to over 2% on previous corresponding periods. So they actually grew their margins. Now, that might just be Suncorp, but it's unlikely just to be Suncorp. I think that sets a really good tone for the other banks. Now, we've got Commonwealth Bank, the biggest bank, reporting their profits tomorrow, their full year number. And I think what we're seeing anecdotally with some of the regional banks and Suncorp today is that banking's a much better business now than people thought it was going to be. So I still think that sector's come upgrade.
So you're expecting good things from Commonwealth Bank. You'll be going to the net interest margin. You'll be going to the provisioning.
Yeah.
You'll be going to the dividend as well, won't you?
So I think $1.53 is kind of what's baked in by the market. So that's just over $3 a share, fully franked for the year. So that's a reasonably good yield, but it's nowhere near as was it when these guys were paying $4.50 a share not that long ago. So if you remember, APRA imposed a cap on how much of their profit they could pay out as dividend. They've subsequently removed that. So CBA is probably the first bank that actually push above that 50%. So there may be Matt Commons feeling good and he might actually pay a little bit more, or at least signal like James Hardie did today that we'll be returning to a normal dividend policy going forward.
Yeah, I mean, strategically, we'll never know what it's like to be CEO of a bank, but especially given the environment. You know, there's two ways to think about it. They had to take away from shareholders that rely so heavily on these dividends in the last reporting season round, but you also wouldn't want to be seen to be doing fast and loose in this environment, right?
Yeah. I think also we have to take into account the fact that the regulators were just red hot on the banks. Out of that Royal Commission, you wouldn't want to be a bank CEO. You certainly weren't giving your shareholders a pay rise. You weren't giving your staff a pay rise. It was like, let's just keep a low profile. Let's get out of the target. They seem to be out of the target. Never say never, but the regulators kind of moved on. The banking sector's done a lot of remediation. They've spent a lot of money on fines. They've spent a lot of money on consultants trying to clean up their act. Are they there yet 100%? We're not sure, but they've got to be closer. So I think they can probably be a bit more upstanding. They've certainly helped a lot of people during the downturn.
Well, that's what I was going to say. They did their PR exercise. And I mean, it wasn't just PR.
Yeah.
They had to help.
They did the right thing.
And they did, but they did the right thing, right?
Yeah.
So I just was going to say a PS. We'll be speaking with Matt Common live at this time, 3:45 or around about there tomorrow. But just to finish that conversation, would you be a buyer of CBA if we saw the types of gains in its share price tomorrow that we've seen in Macquarie today? So question being, will you pay a price for CBA? Yeah,
would I buy it 7% higher than it is today? I mean, we've got a healthy weighting in our portfolios for CBA. It's tempting to get rid of some because it's so expensive relative to the other banks. And there's always this theory, if you want to buy a bank in a recovering environment, you buy the worst one because it's got the best leverage. So I know a lot of bank analysts like ANZ and Westpac for that reason, but we've got a bit of a quality bias. So I probably favour CBA over the other banks just because it's got a better franchise, but it is starting to get pretty punchy on the valuation. So hypothetically, if they pay a much higher dividend and the stock gets a bit of a rocket tomorrow, we'd probably be more someone to taking money off the table and putting new money to work.
I was looking at the chart the other day and noticed that it's getting back towards that $100 mark that so many people were talking about over the years. And in the era where valuations don't really matter, who knows? Never quite sure. Let's go and round off a busy day. Building materials. James Hardie is one that is very much tied to the performance of what's going on in the construction sector, the United States included. We've seen the data there. It has been absolutely booming. No surprise with the results that we saw today.
Yeah, that was a much better. I mean, they've been upgrading. They've been almost every month they've been upgrading the numbers. So for them to sort of be upgrading again at this result was a bit of a surprise. But things are going very well for them. It's not just a volume story. The volume story is quite strong in the US, and obviously, as people, and the US is more likely to happen as people move out of the cities into the suburbs. They're moving from apartments to detached homes. That's James Hardie's strength. They've got a very strong market share in that fibre cement market. But the other thing that really stood out from the result today is just how well they've done on cost control. Because a lot of companies have used this downturn to say, let's get stuck into our cost structure. And Hardie showed that in spades. They've got margin growth well above their sales growth. The only region that's standing out as underperforming is Europe. They've got 10% margins there. They've got sort of 28 in Asia and 30 in the US. So they've obviously got some work to do in Asia. But again, lots of upside. They guided higher again today. even though the stock's on 26, 27 times earnings, it's a stock you can own for the longer term. So we really like Hardy's.
So Macquarie was the best performer today, roundabout there. Challenger Financial also reported it was one of the worst performers. We spoke with the managing director a little bit earlier on today. Here is some of what he had to say. Well, maybe we don't have that, but Challenger Financial, do you have a thought on that? I mean, where is the blue sky potentially for Challenger?
It's just one to avoid in our view. I mean, probably taking a longer term view here, but they earn very high margins on their annuity business. So they've managed to build up quite a big business selling annuities to people and being able to earn like a 400 basis point margin because they've been investing in high yielding assets, whether it was high yield bonds or property for a while, etc. And those margins are just unsustainably high. You can't make a 4% margin on a product where you're selling at a 2% yields. You need to make 6 on the other side. So without taking a lot of risk, it's very, very difficult to do that. So we just think Challenger's business, their annuity business, their sales started to slow down. They were big in Japan for a while. They've really started to slow down. The appetite for retirement product is not there in a low interest rate environment. And the margins are just under longer term pressure. So it's difficult to predict their results because there's so many swing factors with provisioning and so forth. It's a little bit like Suncorp. They over-earned on their investments. You never know what they're going to do. So, but with Challenger, I think there's better quality businesses out there you can own. We've spoken about CBA, we've spoken about Macquarie, we've spoken about Suncorp. There are better financial services names we think to own than taking the risk with Challenger. So that's an avoid for us.
Okay.
Just to go back to the other side of the conversation as well, we're talking about that Crown ruling coming through. The Star Group, Entertainment Group shares closed up 3.6%. A light flurry of buying notice there.
Yeah.
The rumour mill's alive and well.
Yeah. All right, well, there's lots that still needs to be written, both with Crown and reporting season. We look forward to picking up the conversation next week, Martin.
Great, thank you.
CIO of Shaw and Partners.